All right, Derek, so you told me you're coming in hot today. You got a host of things we want to talk about. We've got banks going out of business. We've got fake money. But I'm going to talk about something that is more practical. I want to talk about the Roth IRA and some cool tricks and cool uses you can use for a Roth IRA that maybe not everybody knows. But I'm going to save that for the end. Let's get into the meat of the matter. What do you want to talk about today?
Well, like when we were talking about doing this podcast, I was like, what are we going to talk about? It's been such a slow news week, you know?
Yeah, right.
Like nothing's happened whatsoever. Obviously, you know what is crazy though? It really, like these stories haven't really hit super mainstream consciousness. Like they're talking about Trump, Biden, like they're talking about a lot of like the political side of things. But like this is such a massive story and it has such implications for like normal everyday people, and it's just a failure of the media to like not cover this story. Like this is a story that's going to like continue to unfold. This is not a story that's wrapped up. So I think hopefully we can provide some good information so people can be informed.
I had a presentation to a local high school class, and a class of maybe, 25 kids, maybe one or two of them had heard something about a couple banks failing, but most of them, that of course was not on their radar. And it's amazing, there's been, how long has it been? 2 weeks now since Silicon Valley Bank?
Something like that, yeah.
Roughly 2 weeks. And I got a text from a couple clients over the weekend, and they were asking me questions about their bank and should they be concerned. And I just thought it was, it seemed, exactly. But it did seem a little bit late to ask that question, didn't it? After three of them have already fallen. So my question to you is part of the reason that maybe there is not as much outrage or fear, is it because bank failures, if you look historically, are actually not that uncommon?
I don't think that's what it is, because it's not that. I think a lot of people don't. Maybe in the mainstream consciousness, they're like, oh, I heard it in my peripheral. It's like, oh, the FDIC is going to be there and it'll be fine. It's not going to happen to my bank. I think that's probably more why people don't care that much. But I'm blanking on what was your the other part of that question?
Is it because that bank failures are not all that uncommon? So if we go back to 1970, there have been over 90 bank failures in the United States. So we often think of banks as being fiduciary. Maybe we shouldn't think of them that way, but we think of them being conservative stewards of our money, right? Mm-hmm. I'm going to put my money in the bank, and I trust that I'm going to be able to come back in a month or 2 months or 5 years later, and if I want that money back, you're going to be able to give it to me. But unfortunately, that's not always the case, is it?
Yeah, and what's especially scary about this time is the reason why people aren't able to go to the bank and get the money, because it's not. You can draw certain analogies to 2008, but it's not a 2008 thing where everyone was investing in like highly speculative nonsense investments. Like that was not it at all. It's like if you want to just go ahead and get right into it. Basically, they were buying like treasury bonds and like we can back up a little bit, but how far back do you want to go? Do you mind if I do the whole deep dive?
Yeah, let's just talk about. So we've had 3 bank failures so far in the United States: Silicon Valley Bank, Silvergate Bank, and Signature Bank, right? And the first one
Credit Suisse
was. Well, that one has that actually gone out of business, or did they just get purchased before it happened?
Potato at this point. Yeah,
right. Yeah. So Silicon Valley Bank was the first to go. Let's talk about that one.
Okay, yeah. So that was the major catalyst. It's actually, I believe it was the 16th largest consumer bank in the United States. A lot of their clients were venture capital firms and startups, hence the name Silicon Valley. It's just because of the proximity and because of the relationships they have with those sort of venture capital startups. Just like everybody else, when everyone was getting PPP loans and everything, like these banks were all of a sudden flush with deposits, like they were getting all these deposits. And then as a bank, you can't sit on cash. That's not really an option for you because you're paying interest to the depositors in cash and you're doing CDs or whatever else. So you have to get a higher yield than what you're paying out to depositors. And the way that they make a return on their money is they either lend that money out or they buy treasury bonds, essentially. Like super They're like highly regulated institutions, so they can't take on a ton of risk. And those are the two things that they typically do.
Yeah, they're not going out there and buying Tesla stock or Google stock,
Or
right?
mortgage-backed securities and collateralized
That's
debt.
crazy.
Yeah,
That's crazy.
insane.
Okay, so they were buying treasuries, and they bought a lot of treasuries, old
Yes.
treasuries that were paying below 2%.
Right. Yeah. Because if you remember, like when the pandemic hit, Federal Reserve slashed interest rates to record lows near zero. Those, if you buy treasuries during that time period, you're going to get 1% on your money if you're lucky. So, and to do a quick tangent on how bonds work, when we do this every once in a while, but it's a good mental exercise. When rates drop, bonds rise in value because the old bonds, let's say they're paying 3%, and then when the rates drop, the new bonds are paying 2%. Those old bonds are more valuable because they're paying the higher interest rate, and the new bonds are paying a lower interest rate, and that works exactly the opposite reason. When rates go up, the new bonds are more attractive because they're paying a higher interest rate than the older bonds, which decrease in value.
Yep, absolutely. Mm-hmm. So what was Silicon Valley's problem?
So the problem was during 2020, 2021, they were buying all these treasury bonds yielding effectively nothing. And they were kind of like, I don't know how much blame you want to put on the Federal Reserve here, but the Federal Reserve was basically saying inflation is transitory. Inflation is not something that we're going to have to worry about. So If you're going to make an investment decision, you probably put a lot of weight in what the Federal Reserve has to say. So you're like, if I buy a 10-year treasury bond here, I'm probably going to be fine because inflation's not going to be a problem and they're not going to have to raise rates for a while. If you remember some of the rhetoric, they were talking about, we're not even thinking about raising rates until 2024. That's like, so some of these things. So people actually make investment decisions, especially institutions like banks. They'll make investment decisions based on what the Federal Reserve says. So when they come out.
I would say that has been accelerated in recent years. If you look at the FOMC meetings that happen and some of the, break apart the language and some of the things they talked about, and you'll see markets react wildly based on just commentary that the Federal Reserve is making.
Yeah, for sure. Yeah, people put a lot of weight in what he says because that affects all assets. In particular, that really affects bonds. So they buy all these bonds, and the drum that we kept beating last year was cross asset bear market. Cross asset bear market. This is the worst performing year for bonds since when we had to go back like many decades before we found a year that had a double digit drawdown in fixed income. And this was kind of an under the radar thing, but in hindsight, these kind of catastrophes are always like crystal clear in hindsight when you have these institutions buying buckets and loads of bonds, and there's a cross asset bear market where bonds, as the BND index fell like double digits. It's kind of clear that the banks would be in trouble because they have a lot of exposure to these types of bonds. But there's a weird accounting trick that banks can do where they can basically say, oh, these bonds, let's say they bought a bond for $1,000, but the market value of the bond is $60 because it fell so much. The banks can say, no, this bond is worth $100 because if we hold it to maturity, we'll get our $1,000. I think I said 1,000. Sorry, we'll get our $1,000 back. So this is worth $1,000. So on paper, or I guess on their balance sheet, they haven't lost any money. But like in reality, the unrealized gains are like really, really high. So
yeah. Well, there is some truth to that, right? If I hold an individual bond to maturity and assuming it doesn't default for some reason, I do get it back. But yeah, you can see that, you can't, when you think about, someone once told me that, like when you buy a stock, you haven't lost anything unless you sold it, right? If it goes down. But that's not the case if your mortgage company says, hey, Derek, let me see your financial statement, and you send them over your investment account and you say, oh, by the way, we're going through a bear market, so don't count this as a loss.
Yeah, right.
It's not going to happen.
Yeah, that's a really good point because it's a duration mismatch because banks have to meet a lot of short-term liabilities. They have to make short-term obligations where their depositors want their money back. That's going to be the main reason, is if all the depositors come for their money back, that's a very short-term obligation that they're going to have to come up with all the money instantly. And but they have all of their assets in long-term assets, like a 10-year Treasury bond, which, yes, in theory would be okay because they don't have to worry about the swings in the market because they could just hold it to maturity and get all of their money back. But the issue arises when there's that duration mismatch, when everybody starts coming for their deposits and you have all your money locked up in long-term assets. Yeah.
Now you're in trouble.
Yeah, and that's basically what happened. So Silicon Valley Bank was in trouble. They needed to raise a lot of cash because they started doing math and they were like, hey, if people start coming for their deposits, we don't have the money. So they started selling some of these bonds at like a crazy loss. So when they realized
$1.8 billion.
Yeah, and I think that was only that. So that's what they sold initially, and then like on their books they had like a ton of other unrealized losses. So when they actually sell the bonds, they have to realize that loss, and that accounting trick doesn't really work anymore. So now it exposes how much losses are actually on your books, and then you saw a bunch of like venture capital firms advising their startups to pull all of their money from Silicon Valley Bank, and then the rest is history.
Yeah. So the other two banks, Signature and Silvergate, were more crypto-related banks, right? Leveraged to crypto.
I believe it. Yeah, Signature Bank was. Yeah.
Oh, I read that both of them were actually, but
it's possible.
Okay.
I know for a fact Signature is.
So that is typically not, if you look at your average depository bank that somebody would have on Main Street, that's probably not a large exposure that somebody would have. So I guess the question that everybody's asking right now is, do I need to be concerned about my regional bank?
Yeah, it's tough because there's so many like unless you're going to do super fundamental analysis about your bank's assets and liabilities, it's really tough. So this is a reason why the contagion is kind of spilling over to some of the other regional banks. So for Silicon Valley Bank, 97% of their deposits were over the FDIC insured limit. So the FDIC kind of, I never followed up on this, but they said the bank closed on Friday, and then they said by Monday everybody's going to have all of their money, even if it wasn't FDIC insured. FDIC insured just means less than $250,000 in deposits.
Right.
So if you're a depositor, and let's play devil's advocate. Let's say they didn't. We'll call it a bailout, but they were not calling it a bailout, and they didn't. Yeah. let's say they didn't do this bailout, and you have $1 million with another regional bank. You have every incentive in the world to go pull that money out and go give it to JP Morgan, because JP Morgan has $1.3 trillion in cash, $3.7 trillion in assets. So,
and it's the last bank that the federal government would allow to fail.
Sorry, my dog was barking. But yeah,
I'm sorry.
No. Yeah, but yeah, you're exactly right. So, which would then cause a bank run on all these smaller banks, and then it would just be aggregate all the capital to the larger banks. And then when you think about it from the dominoes perspective, you just see more and more of these regional banks fail, which is more likely to spread contagion to the larger banks.
Yeah. When this happens, you get consolidation, right? Because number one, you lose a bank. Mm-hmm. So people have to go find a new place to do their banking at, whether they're a business or individuals. But the winners of this whole thing, as you just stated, are the Citigroups, the JP Morgans. They're the very large banks that are not going to be allowed to fail, or at least they're going to be the last to fail in the event that happens. So did you, in your research, get into anything about the FDIC insurance?
So the only thing that I found interesting was that I guess FDIC insurance doesn't really matter anymore if they're just going to insure all the deposits.
Well, it's so last week we talked about Senator Warren
mm-hmm.
and some of her statements. So she's on her tree stump again, and she's saying one of the ballots that need to be on the table is that FDIC limit insurance must be increased above $250,000. What is, and I wrote about this a little bit in our newsletter. What's frustrating and why the public deserves to be outraged by these bank failures is we think of a bank and it's insured, right? And then if you go to the FDIC.gov website, they'll tell you that this is insurance. This insurance is not provided by the American taxpayer. It's actually provided by the institutions themselves that are FDIC insured. They provide the premiums that go towards insuring this. But where does a bank get its money? A bank gets its money from the depositors, right? Whether they're businesses or individuals. So ultimately, This does come from the American taxpayer. It does come because if you're a taxpayer, you've got income. If you've got income, you likely have a bank account, which means that you're providing the funding for that.
So I was under the understanding that banks actually don't like making money, and when they have to bail out these banks, they're not going to pass that on to the consumers. They're just going to eat that cost. I was under that assumption.
They'll take full responsibility.
Yeah, they're just like,
our bad guys.
Yeah. Yeah.
This was a miscalculation. I don't know what we needed to change the batteries in our calculator. Apparently.
Yeah. Right. So I was going to talk about the this new tool that the Federal Reserve is using to like kind of put everybody at ease. Did you read anything about that?
Are you talking about the payment system?
No, it's but that's really interesting too.
We need to talk about that in the future.
Yeah, I don't have enough to talk about today, but we'll definitely talk about that in the future. But so basically, the Band-Aid that the Fed is putting on these bank runs is they are allowing you to. So, let's say you bought a bond for $1,000. Due to interest rates, that bond is now on the market worth $600.
I could barely hear your dog, so it wasn't that bad. Actually.
Okay, that's good. On my audio, it's spiking like crazy though.
Oh, is it?
Yeah. Every time she just like stares out the window, and then she sees another dog, she freaks out.
Pisses off.
Yeah.
I wish humans were that way. You just shout at them from your window. Hey,
get out of here. All right. So sorry. I believe where I was. So you buy a bond for $1,000. Due to interest rate increases, that the market value of that bond drops to $600. So you can now get a loan from the Federal Reserve for the at maturity value of that bond. They'll give you $1,000, and you have to repay that at maturity. So it's not technically QE because the money has to be paid back, but it's a way that kind of shores up the balance sheets from these unrealized losses. The interesting thing is there are some banks that don't have a ton of exposure to the bonds. Their unrealized losses aren't in the bonds, but in the loan side of their business. And this contagion effect will kind of spill over to these banks that don't have a ton of bonds on their balance sheet, but will still be subject to large unrealized losses. So for the time being, we're kind of waiting to see who falls into that camp, but inevitably somebody will.
So one of the things that I've noticed in recent years is that a lot of the public has waken up to the idea of fractional reserve banking, how banks in the United States and largely around the world work, in the sense where they take our deposits, and you had stated earlier, for the most part, they just can't keep them in cash because they have to exceed what they're giving out to reward us as depositors, right? Mm-hmm. So they go out and they have to take some form of risk with our money, and whether that's a very conservative risk or something that's a little bit more aggressive. And what we find is that a lot of times the risks are not known during the growth cycle. And right. when we're going out and we're investing in a crypto platform, or we're going out and we're buying way more bonds than we should have exposure to at one point in time with a certain amount of duration to that, it's covered up in the growth cycle, and then it manifests itself during the contraction. I've noticed in recent years, and whether maybe it's the books I've been reading or some of the shows I've been listening to, but there has been questions on the strength of the fractional reserve banking and how long it can last before it just gets silly and we're just printing money in order to satisfy these banks to keep them in business. Is that something, do you think, that is that these three bank failures are maybe shining a light on, or is it something where we talk about it for a week and it gets swept under the rug and we move on and wait for it to happen again?
I personally have the belief that, to take the pessimistic point of view, that inevitably this will be forced into the mainstream conversation. I don't think we're done. I think this is going to spill over to other banks. I think you're going to see, I think there will be some real teeth and some real consequences to this. It's interesting because they weren't, Silicon Valley Bank in particular wasn't, that's kind of the A narrative that's being spun, is they were taking on all this risk, having exposure to startups. It's not true. All of the losses that caused the downfall to the bank were treasury bonds. So supposed to be the safest asset in the world, like the U.S. Treasury bond. But you made a really good point of this stuff gets exposed during the contraction, and that was kind of my point about some of these regional banks that don't have a ton of exposure to treasury bonds, but. Let's say commercial real estate, for instance, I believe 70% or 60 65 to 60 or 65 to 70% of the commercial real estate, the lending comes from regional banks. So let's say you have all of your exposure to commercial real estate and they're all solid cash flowing businesses in the boom. Okay, what happens when we go through a deep recession and some of these places can't pay rent? And then there's no funding window that they could like mark up the value of the property and get a loan for. There's nothing that exists like that. So they're either going to have to like expand these bailouts to basically include everybody, or like let a lot of these regional banks fall, and then if contagion happens, so be it, or save the too big to fail. I mean, so something is definitely going to happen. It's just and none of the options are super rosy, but like we're just kind of waiting and seeing what's going to play out.
It's interesting to me. I tend to watch these things. Obviously, I'm an investor. We're investing clients' money. We're on top of this. There's a part of me that, as a historian, tries to see this from almost like a third party non-opinionated observer. And what is interesting to me is interest rates have gone up very fast. And I think that's part of the problem, is the speed at which we raised the interest rates.
Yeah.
These banks didn't have a whole lot of time to react to that, right? But largely where we're at that federal funds rate, which is somewhere around 4.58 right now, I believe, or within a couple tenths of a point, the economy is still pretty strong. Employment's strong. I mean, this is not, to your point, this is not 2008. This is nowhere near 2008, and yet we are starting to see some cracks occur within the financial system. That worries me a bit.
So
in systems that are supposed to be sound.
Mm-hmm. And especially for like how financialized the U.S. economy is. Like all these banks are so intertwined. All these businesses are so intertwined with the financial sector that it's like the contagion is really what worries. Is that like the kind of that domino analogy where a small domino seemingly harmless falls over. Like, I mean, let's say Silicon Valley Bank was completely isolated, it would pretty much only affect VC and startups. But because it's so intertwined with the financial system, and the financial system is so intertwined, that's why it spills over into all this other stuff.
So you had brought this up to me shortly after Silicon Valley Bank failed. You had said, here's the problem that you might see unfolding. On one end, you have the Federal Reserve, which is trying to dry up the money supply, try to kill demand, bring inflation down. And if we have bank failures, they are going to be forced to spend money, right? They're going to be forced to provide liquidity. And couple that with the fact that within a couple months here, we have the debt ceiling coming due that we're going to have to negotiate for. So we talk about the Federal Reserve being in between a rock and another rock.
Yeah,
I mean, it keeps on getting more challenging for sure.
Yeah, that's really interesting too, because like you said, by the metrics used by economists, the economy is doing really well. Unemployment's at like near record lows. If you look at the services sector, still ripping. The goods sector is a little bit. That's kind of where all of the deflation is coming from that we've seen. The breakdown from 9% CPI to 6%. A lot of that was driven by the goods part of the economy. But there's actually some really interesting numbers, like when we got CPI this month, just last week. A lot of if you look at it from a 3-month rate of change basis, a lot of the inflation numbers that the Fed looks at to really determine where inflation's heading, those are actually re-accelerating from at paces haven't seen since last year in October. So so a lot of people think that the Fed's going to come out on Wednesday, that's tomorrow, or maybe today, depending on when we release this, that they're going to completely pivot because they're more concerned about the financial sector than they are about inflation. That's probably too early to make that call because
maybe too simplified of an explanation.
Yeah, right. I mean, just because we've talked about on countless podcasts, the Fed cannot allow inflation to become entrenched. That's a way bigger problem than because we're talking about a multi-decade problem that takes excruciating pain to solve. It's so the reaction function of if the Fed looks at the current situation, they're like, okay, Credit Suisse, that's not an American bank, super big bank that's intertwined with the American financial system for sure, but that looks like it's solved. Silicon Valley Bank looks like it's solved. So on Wednesday, they don't really have enough of a reason to stop that fight against inflation, at least in my opinion. I think for them to step in and change their strategy and basically not worrying about the inflation mandate and going back to worrying about the financial stability mandate, I think things are probably going to have to get a lot worse.
I want to take a moment to talk about people. Obviously, these events cause people to ask, is my money safe? So our two custodians, Charles Schwab and SEI. SEI was our first custodian. They are a private trust company. It's SEI Private Trust Company. There are magnitudes of safety in custodying money through a private trust that are above and beyond what a bank can provide. Number one, the assets are titled to you and they are held outside of the company in trusts. So SEI gets lawsuits, they crumble as a company. These assets are held outside of the company, titled to your name in trust. Two, a brokerage house is able to lend money. A brokerage house typically has some bank connection to it. Charles Schwab has a bank to it, right? We're going to get to Charles Schwab later. But they can use margin, they can lend, they can commingle funds, they can pledge money. That can't be done with SEI. So there is no lending, there is no exposure where the way SEI is positioned is if 100% of their account holders came at the same time and said, give me my money, the money's there to give them. Mm-hmm. So it's really impossible to have a run on SEI as a custodian. In the financial industry, SEI is not the only company that does private trust, but within the financial industry, there is no safer way to custody money than through a private trust. Charles Schwab now, that doesn't mean necessarily that Charles Schwab is dangerous. We saw Charles Schwab stock fall pretty significantly 40%. when they were having this bank runs, because it does have some, it's the largest brokerage firm. It does have some bank exposure to that. Charles Schwab is a pretty conservative brokerage account. It is highly, highly regulated. Cash accounts in Charles Schwab are insured up to $250,000, and securities, stocks and bonds and things that you would buy, or the $500,000, I believe, Derek, is what they're insured for. So that does have some protection to it. Now, of course, that would be good as the value of the account. If I've got $1 million account, maybe I would ask myself the question: does all of it have to be in one brokerage house? And it's, of course, only as good as the insurance in it, right? And we have done our due diligence. We use Charles Schwab because they provide some services that many of our clients want, right? And I would say that they are from what I've seen, they're well positioned in the fact that they have $500,000 of insurance on the security portion and $250,000. I think helps investors sleep a little bit better at night.
Sure.
But that is probably, we don't think about this. In 2000, when we were experiencing double-digit growth in the S&P 500. We're typically not thinking about the security of our bank. We're not thinking about the security of our brokerage fund. But that is something that we want to ask ourselves the question. And I know as a firm, as Crosby Advisory, we are going to talk about that more and more in our initial meetings. Why are you choosing SEI? Well, let me tell you about that. And so I wanted to give clients a little bit of background on that as far as the safety of their money.
Yeah, sure. I think that's good. And then to continue the conversation, like extending what you just said out to like your own personal checking account, I think that there's some things you can do. Obviously, like you have to have some level of faith in the FDIC to enact this strategy. But if you have over $250,000 in your checking account, either look into multiple banks or like money market funds, CDs, treasury bills, stuff like that. Like anything over that $250,000 limit, it's at least worth looking at it and seeing if there's some easy things you can do to mitigate your risk. Because like when turmoil happens in the financial industry, you just don't know who's going to get caught exposed. So it's always better safe than sorry.
Yeah, I mean, I think that's, as a general rule, you're right on there. I mean, it's not that hard to diversify from banks. I have 3 banks that I use. And the struggle gets when you're a business, right? And if you're a business, there might be some times where you have more than $250,000 in deposit on one time that you would have to make that call, right? You would want to pay attention to your bank, and maybe you do still want to split it up. I know it becomes a little bit more of a headache and hassle if I've got multiple banks to reconcile for tax purposes and accounting purposes. But I think it does make sense to, as we have seen, it can happen at any time. It does make sense, I think, to diversify that.
I have some numbers here on how much some of the companies with Silicon Valley Bank, how much they had. So Roku had $487 million with Silicon Valley. Roblox had $150 million. BuzzFeed had $56 million. And Circle, who made the crypto USDC, the stablecoin, they had $3.3 billion of their $40 billion in Silicon Valley Bank. So, obviously, you don't want depositors to have to be concerned about their funds, and you want them to just be able to not. That's one less thing to worry about is cash in the bank. But at the same time, it's having $500 million in a bank account seems like just bad cash management. Cash management.
For sure. Yeah, for sure. Well, Derek, on this topic, anything else you want to talk about? You had mentioned in the beginning some fake money. What's going on with that, or did we already talk about that?
Oh, well, I mean, just as a reminder to everybody, as soon as you put money into the bank account, that is not your money anymore. That is a liability of the bank. So I just wanted to make that explicitly clear. And that's something to always remember. So when you put your money in a bank, they lever that up 10 to 1 and the money is gone. The money is not there. If you need it, if everybody went to any bank in the United States and requested all of their money at once, no bank would be able to service every single one of those.
Including JP Morgan.
Yes, yes. So just want that to be abundantly clear to everybody and something to consider as things may get a little shaky with banks and stuff.
Yeah, absolutely. Absolutely. Well, Derek, I'm going to take some time here in getting into the Roth IRA. I'm not going to give you too much of the boring talk. A lot of people, definitely our clients, know about the Roth IRA, have a Roth IRA if they're eligible for that. But I guess I just need to give some background to that, right? Mm-hmm. So an IRA is an individual retirement account. And for most people, the two common ones you see is a traditional IRA, in which you are allowed to make a deposit. And then you can, for many Americans, we can deduct that deposit from our taxes. So it helps lower our current taxation. And then the deal that you make with that at retirement age, which is after the age of 59 and a half, I can withdraw that money and it will be taxed at that point in time. The Roth IRA is the opposite of that. The Roth IRA, I've got money that I got from my paycheck. It has already been taxed. Now I decide to put it into a Roth IRA. I am not making a tax deduction, but the give back on that is going forward. It's never taxed again. The Roth IRA has some distinct advantages which make it a very powerful financial tool for those who qualify. Number one, if you have a client that wants to start out for safer retirement, but they're too stretched, they can't create an emergency fund and they can't create a retirement account, the Roth IRA potentially solves that problem. And what I mean by that is at any point in time, you can pull out of a Roth IRA what you put into it, your principal, without any taxes or penalties. You just can't pull out the growth portion of it. To pull out the growth portion of it without any taxes or penalties, you have to have the account open for 5 years, and you have to be over the age of 59 and a half. If you've satisfied both of those goals, then you can withdraw the entire account balance tax-free. And especially if you start young and you're able to compound that for 20, 30, 40 years, man, that Roth IRA becomes a very, very powerful accumulator within your plan. So let me get back to that. We've got a person who is starting out in life. They want to save for retirement, but they also don't have an emergency fund. They're too stretched to do both. So they start a Roth IRA. The key to that is that funds that we are allocating towards the emergency funds, you can't go out there and buy shares of Tesla. You can't go out there and buy an emerging market fund, right? Those need to be into a money market account, or they need to be in cash. Keep them in cash if that's depending on how your brokerage account operates or your custodian operates. But so if I was that person starting out in life, I'm going to open up a Roth IRA, but I need a $1,000 emergency fund, right? I need a $5,000 emergency fund, whichever is appropriate for that individual. I would begin funding it, and I would not buy any bonds or stocks or real estate or gold until I first satisfy that emergency fund. And then afterwards, we begin to add other asset classes in there as well. The Roth IRA is potentially good for somebody who thinks their child may go to college, but is not sure. Because the cool thing about a Roth IRA, as long as you have earned income, you can contribute to it. And so You have a 10-year-old who has, a paper route or, gets paid to mow the grass or something like that. That money could go into a Roth IRA for the child. And man, start opening a Roth IRA at 8 years old, 10 years old, and compound it for 50 or 60 years.
Yeah.
Now that is a math problem that you want to see. So let's say that the parent wants to give the ability for a child to go to college, but not quite sure if they're going to or not, right? The typical college savings plan would be a 529 plan. And the way a 529 plan works, we talked about this earlier, they just got a lot more competitive in my mind because I can put money in a 529 plan with my state. It can grow without being taxed. And if I pull it out for educational purposes, I can pull it out tax-free. So it can be a powerful college savings tool, or I should just say educational tool. The Roth IRA can be a backup for that. What I mean by that, it's if I match it dollar for dollar against a 529 plan and the child ends up going to college, there's probably no better solution than a 529 plan because it could have grown tax-free. You took a state tax deduction in most cases by contributing, and it can be withdrawn tax-free to pay for education. However, the Roth IRA, if I'm using it for educational purposes, I can withdraw my principal at any time, right? But I can also withdraw the growth without penalty. I will pay taxes, but I won't pay penalty.
Mm-hmm.
So in that case, it's no different than a non-qualified account or any other investment account you'd have. You would pay taxes on the gains that you had in that account. And then if the child doesn't go to college, right? The child, or maybe doesn't use it all because they went to a 2-year school and started a business or started their trade. Well, then it can continue on as a retirement account for the child. So it's kind of a solution where, hey, I don't know if a 529 plan is right for me, but I still do want to start saving for education. The Roth IRA kind of Swiss Army knife fits that role a little bit. The other thing about a Roth IRA is if you're using it for paying for college, here's an interesting fact, Eric. The Roth assets are not counted on the FAFSA form when determining if the child should get financial aid or not.
Interesting.
Here's the trick, though. So if a child has a 529 plan in their name, those assets are going to be counted as assets in the child, right? So the trick that you use with a 529 plan is you put the 529 plan in the grandparent's name. Or in that way, those assets, at least immediately, are not counted when considering financial aid. However, when the grandparents sell assets out of the 529 plan to give to the child to pay for college, it's shown up as income for the child, which will then be determined in future years for consideration on financial aid. So here's the trick. If I've got a Roth IRA that I'm potentially saving for a college for my child, that's the last asset I'm going to use to pay for college. Those first 2 years or first year or 2 years, depending on how long they go to school, the first part of college, I'm going to use other money, grandparents' 529 plans, whatever might be out there to pay for that. And then the Roth portion would be used last because, number one, it's not counted as an asset for the FAFSA purposes. But like the 529 plan, once I liquidate it and I give it to the child, it's going to be considered income for the child. So we would use that last to do.
Yeah, interesting.
Yeah, pretty cool stuff, right? The other thing that people don't think about a Roth is for first-time home buyers. And do you know what the IRS classifies as a first-time home buyer?
The first time you buy a home.
You're correct with that. But also, if you've gone a 2-year period without owning a home,
Okay.
and you go to buy it again, you can be considered a first-time home buyer. So
You should probably change the name of that.
yeah, right. It's the IRS, right? We got to be as confusing as possible. So both the traditional IRA and the Roth IRA allow you to use $10,000 penalty-free for the purchase of a first-time home. Here's why a Roth IRA becomes more powerful. That $10,000 is allocated towards the portion of the account that is in penalty. So with a traditional IRA, the entire account's in penalty, right? Mm-hmm. If I'm under the age of 59 and a half. With a Roth IRA, only the growth portion is in penalty. So I can withdraw my cost basis and then also $10,000 of my gain to use for a down payment on a home and not pay any penalty on that, where that's just not the case with the traditional IRA. So if you look at that, the Roth becomes a pretty, there's no such thing as the only account that you need. But a Roth IRA becomes a very powerful tool because it's very versatile. You maintain access to your principal along the way. It grows tax-free. It can be used for other things if you need to. It doesn't have an RMD on it. The government's not going to come to you and say, Derek, we need you to start pulling money out so we can tax it. And eventually, Derek, you're going to pass that on to your child or grandchildren. If it's in a Roth IRA, you can pass that tax-free to them as well.
Yeah, that's super cool.
Cool. Well, good episode, Derek. I have to take off running here, so this ended right on time. So tell them where they can find us on social media.
As always, thanks everybody for listening to the podcast. If you liked it, like, share, subscribe, wherever you get your podcasts. Follow us on Facebook, Instagram, LinkedIn. Get clips from the episode on YouTube, as well as watch the full episode on video on YouTube at Crosby Advisory. Subscribe to the newsletter by going to crosbyadvisory.com/contact. And we'll see you guys next week.
Next week, actually, I'm heading to Chancellorsville.
I'll see if what Carly's doing. Maybe me and her can do a podcast.
So I bought a that is all around. Don't turn me in here. Don't turn me in, guys. I'm really into metal detecting treasure hunting. I do that with my daughter. My daughter loves to do that. And we have metal detectors of all kinds. I bought a foldable metal detector that I can stick in a backpack and take wherever. I've taken it to a couple of metro parks and things around my house.
And you definitely didn't dig anything up. That would be illegal.
That would be illegal. I just want to find them, right? I just want to know that they're under my feet.
Yeah.
That's all, right? So, all right, guys, keep in mind that Crosby Advisory is a registered investment advisor in the state of Ohio, Texas, and Florida. At any time, you can request our forms ADV 2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today on the show, Derek and I mentioned specific investments, and that is not a recommendation for you to buy them or sell them. Do your own homework and make sure they are suitable for you. Keep in mind, investing involves risk, including the potential loss of principal.